The Roth conversion trap. Most retirees don't see coming. Most retirees are told the same thing. Convert to Roth. Pay taxes now. Enjoy tax-free income later. It sounds simple, it sounds smart. And in many cases, a Roth conversion can be a powerful retirement strategy. But here is what most retirees are never told. A Roth conversion can also backfire. Not because Roth accounts are bad, but because converting the wrong amount, at the wrong time, in the wrong year, can create a tax problem you never expected. And sometimes, the mistake doesn't show up immediately. It shows up later, in a higher tax bill, in higher Medicare premiums, in more taxable Social Security. This is the Roth conversion trap. And today, we are going to break it down. Clearly, let's start with the basics. A traditional IRA or 401k is tax-deferred money. You haven't paid taxes on it yet. When you convert it to a Roth, you're moving it into a tax-free bucket. That sounds great, but the IRS doesn't ignore that move. The amount you convert is treated as taxable income in the year of conversion. So if you convert $50,000 or $100,000, that entire amount lands on top of whatever income you already have. Social Security, pensions, dividends, rental income, part-time work. Now imagine a retiree who already has $80,000 of income for the year. They decide to convert $150,000 into a Roth. On paper, smart long-term move, but now their income has jumped to $230,000. They get pushed into a higher tax bracket. More of their Social Security becomes taxable. And because Medicare uses a 2-year income look-back, they may have triggered higher premiums in a future year. That one decision, which felt like an account transfer, just became a major tax event. Here is the biggest mistake retirees make. They think the goal is to convert as much as possible, as fast as possible. But that's not the real goal. The smarter question is this: how much can you convert without creating unnecessary damage? Because there is a huge difference between a strategic conversion and a panic conversion. A strategic conversion fills up a lower tax bracket carefully. It looks at this year and future years. It considers Medicare. It considers Social Security. A panic conversion throws a large amount into income and hopes it works out. It only thinks about avoiding required minimum distributions someday and ignores everything else until the bill arrives. That's where retirees get caught. They do the right idea in the wrong way. Let's talk about something most financial videos skip over: the Medicare 2-year look-back. Medicare premiums are not fixed. They are based on your income, but from 2 years ago. So a Roth conversion you do today can raise your Medicare premiums in a future year. Many retirees don't connect these two things. They do the conversion, they pay the tax, they think it's finished. Then 2 years later, a higher Medicare bill arrives, and they don't know why. The answer is simple. In retirement, income decisions are connected. A Roth conversion affects taxes. Taxes affect cash flow. Income affects how much Social Security is taxable, and income affects Medicare premiums. One decision does not stay in one box. Roth conversions are not one size fits all. A retiree with a large pension is in a completely different situation from someone living mostly on Social Security. A married couple filing jointly has different tax brackets than a single retiree or a surviving spouse. And that's the hidden issue for many couples. When one spouse passes away, the survivor often loses one Social Security check. But many household expenses stay the same. And in future tax years, they now file as a single taxpayer. Single filers hit higher tax rates at lower income levels. For some couples, doing smaller Roth conversions during the married years can reduce future tax pressure for the surviving spouse. But again, the amount matters, the timing matters, the plan matters. Now, when does a Roth conversion actually make sense? The best window is often the years after you retire, but before required minimum distributions begin. Why? Because income may be lower. You're not yet forced to withdraw money, and you may have room to convert some amount at a manageable tax rate. But that does not mean every retiree should convert aggressively. It does not mean you should empty your IRA, and it definitely does not mean you should copy someone else's plan, because retirement tax planning is personal. So before you convert a large amount, ask yourself these 5 questions. 1. What tax bracket will this conversion create this year? 2. Will this affect my Medicare premiums 2 years from now? 3. Will this make more of my Social Security taxable? 4. Will this help or hurt my spouse if I pass away first? 5. Am I converting with a plan, or am I reacting out of fear? Because Roth conversions are not magic, they are tools. Used correctly, they create tax flexibility. Used carelessly, they create a tax surprise. The real goal is not just to build a Roth account. The real goal is to keep more of the retirement you worked your whole life to create. If this video helped you think differently about your retirement strategy, hit the like button and subscribe so you don't miss what's coming next. And if you have a question about your own situation, drop it in the comments below. We read everyone. This video is for educational purposes only and is not financial advice. Please consult a qualified tax or financial professional before making major retirement decisions.